You could have turned $10,000 into over $1 million in the last decade. But here's the truth, 90% of people who try to beat the stock market fail. So what's actually happening when you buy a stock? And more importantly, how do beginners avoid losing everything? By the end of this video, you'll understand exactly how the stock market works, what you're really buying, and the one strategy that actually gives beginners a fighting chance. Let's start with what a stock actually is, because most people get this completely wrong. When you buy a stock, you're not buying some abstract number on a screen. You're buying a tiny piece of an actual company. Think of it like this. Imagine a pizza cut into 1 million slices. Each slice is a share of stock. When you buy 1 share of Apple, you literally own 1 tiny slice of Apple. You're a partial owner of their stores, their products, everything. But here's where it gets interesting. That slice of pizza, its value changes every single second based on what other people are willing to pay for it. And this is where fortunes are made and lost. The stock market is basically a giant auction house. Buyers and sellers meet electronically, and they negotiate prices in real time. When more people want to buy than sell, prices go up. When more want to sell than buy, prices drop. So who decides what a company is worth? Well, theoretically, it's based on how much money the company makes, how fast it's growing, and what people think it'll be worth in the future. But here's the twist nobody tells beginners. Markets aren't always rational. Fear, greed, news headlines, tweets from CEOs, all of this moves stock prices, sometimes more than the actual business performance. This is why timing the market is nearly impossible, even for professionals. Let's talk about how you actually buy stocks. You can't just walk up to the New York Stock Exchange and yell, "I want 10 shares of Tesla." You need a broker, basically a licensed middleman who executes trades for you. These days, that broker is usually an app on your phone. Robinhood, Fidelity, Charles Schwab, E-Trade, they all do the same basic thing. They connect you to the stock exchanges where shares are bought and sold. Most charge 0 commission now, which is huge for beginners. Here's how a trade actually works. You open the app, search for a company, and place an order. That order gets sent electronically to an exchange, like the New York Stock Exchange or NASDAQ, where it's matched with someone willing to sell at your price. Usually this happens in milliseconds. There are 2 main types of orders you need to know. A market order means buy this stock right now at whatever the current price is. It executes immediately. A limit order means only buy if the price hits this specific number I choose. This gives you more control. Now let's talk about how people actually make money from stocks. There are 2 ways. First, price appreciation. You buy a share for $50, it goes to $70, you sell it and pocket $20 profit. Simple enough, right? Second, dividends. Some companies share their profits with stockholders by paying out cash every quarter. It's like getting rent for owning the stock. Not every company does this. Fast-growing tech companies usually reinvest everything back into growth. But here's what nobody tells you up front. The stock market isn't some secret money printer where you just press buttons and get rich. It's volatile, it's unpredictable in the short term, and it's designed to reward patience, not quick wins. Let me show you what happens to most beginners. They hear about a hot stock, maybe it's in the news or trending on social media, they pour money in hoping to double it quickly, then the stock drops 20% in a week, panic sets in and they sell at a loss. This is called emotional trading, and it's the #1 wealth destroyer for new investors. You buy high when you're excited, you sell low when you're scared. This is the exact opposite of what works. So what does work? Here's the part that changed everything for me. Time in the market beats timing the market. Historical data shows the S&P 500, which tracks 500 of America's biggest companies, has returned about 10% per year on average over the long term. That doesn't mean it goes up every year. There are crashes, there are recessions, but if you stay invested for 10, 20, 30 years, the overall trend is up. The stock market has recovered from every single crash in history. Let's do some math. If you invested $10,000 in an S&P 500 index fund 30 years ago and never touched it, you'd have over $200,000 today. That's the power of compound growth and patience. But here's the catch nobody tells you up front. You have to actually stay invested through the scary times. In 2008, the market dropped nearly 40%. In 2020, it dropped 34% in weeks. People who sold during those crashes locked in massive losses. People who held on or even bought more are wealthy today. Now, let's talk about day trading, because this is where beginners lose the most money. Day trading means buying and selling stocks within the same day, trying to profit from tiny price movements. It sounds exciting. It's also a statistical nightmare. Studies show that about 95% of day traders lose money over time. You're competing against algorithms that execute millions of trades per second, professional firms with billion-dollar technology, and decades of market data. As a beginner, you're outgunned. Instead, here's what actually works for beginners. Index fund investing. An index fund is a basket of stocks that tracks a market index like the S&P 500. When you buy one share of an S&P 500 index fund, you instantly own tiny pieces of 500 companies. This is called diversification. Instead of betting everything on one company, which could go bankrupt, you spread your risk across hundreds of businesses. If Apple has a bad quarter but Microsoft has a great one, your portfolio stays balanced. Index funds also have incredibly low fees. Traditional mutual funds might charge 1 to 2% per year in management fees. Index funds charge as little as 0.03%. Over decades, those fee differences compound into hundreds of thousands of dollars. Warren Buffett, one of the greatest investors ever, recommends index funds for regular people. He literally bet $1 million that an S&P 500 index fund would beat professional hedge fund managers over 10 years. He won that bet easily. But what about individual stocks? Should beginners avoid them entirely? Not necessarily. Once you have a solid foundation of index funds, you can experiment with individual stocks with money you can afford to lose. Think of it like 90% index funds, 10% individual picks. If you do buy individual stocks, here's the golden rule. Invest in companies you understand. Can you explain what the company does, how it makes money, and why customers choose it? If not, don't buy it. Mystery investments lead to panic selling. Let's talk about the biggest risks. Risk number 1, putting in money you need in the short term. The stock market can drop 30% in any given year. If you need that money for rent or a car payment in 6 months, it doesn't belong in stocks. Risk number 2, not having an emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in a regular savings account. This prevents you from panic selling stocks when your car breaks down or you lose your job. Risk number 3, checking your portfolio constantly. This leads to emotional decisions. The more you check stock prices, the more likely you are to see red numbers and panic. Successful long-term investors check maybe once a quarter. Here's your beginner strategy that actually works: dollar cost averaging. Instead of investing all your money at once, you invest a fixed amount every week or month, regardless of whether the market is up or down. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your cost and removes the stress of trying to time the market perfectly. Let's say you invest $200 every month into an index fund. Some months you'll buy when the market is expensive, some months you'll buy during a dip. Over years, you've systematically built wealth without needing to predict anything. One more critical concept: tax-advantaged accounts. In the US, accounts like Roth IRAs and 401ks let your investments grow without paying taxes on the gains, or you get tax deductions now. This is free money from the government. Use these accounts first before regular brokerage accounts. If your employer offers a 401k match, that's literally free money. If they match 50% of your contributions up to 6% of your salary, you're getting an instant 50% return before the stock market even does anything. Never leave that on the table. Now, let's address the elephant in the room. What about crashes? What about recessions? Yes, they will happen. The market will drop. Your portfolio will show scary red numbers. This is when your strategy gets tested. Here's the mindset shift. When stocks go on sale at the grocery store, do you panic and refuse to buy them? No, you load up because it's a good deal. Market crashes are the same thing. Everything you wanted to own just went on sale. If you have cash and you keep investing, you'll buy more shares at cheaper prices. The people who got rich from the 2008 crash weren't the ones who sold everything. They were the ones who kept buying. The same thing happened after the 2020 pandemic crash. Markets not only recovered, they hit all-time highs within months. So, here's your action plan as a complete beginner. Step 1, open a brokerage account with a reputable broker. Fidelity, Vanguard, and Schwab are all great for beginners. The apps are user-friendly and customer service is solid. Step 2, start with an S&P 500 index fund or a total stock market index fund. Look for ones with expense ratios under 0.1%. Vanguard's VOO and Fidelity's FXIAX are popular choices. Step 3, set up automatic monthly investments. Even if it's just $50 a month, consistency matters more than the amount. Automate it so you're not tempted to skip months or time the market perfectly. Step 4, ignore the noise. Financial news wants you to panic because panic drives clicks. Mute the alerts, stop checking daily prices. Trust your strategy and give it time to work.